I have a book. It's a good read for anyone who needs to read a book about sales taxation. Actually, it's very interesting. It's by
Is it an audio book?
John Mike Sell, Sales Taxation, State and Local Structure and Administration. Highly recommend it. He's a professor at University of Indiana. At one time was at West Virginia University several years back. And he's probably the foremost authority on sales tax structures. He studied consumer sales tax differences between states for many, many years. Unlike income taxes, the sales tax will vary rather significantly from one state to another. There's not a whole lot of uniformity on the sales tax. And with that, I'll open up on the, we're dealing today with the consumer sales and service tax, and I open up again with the comparative chart of tax rates of surrounding states. Of course, the sales tax is one of the three legs of a three-legged stool of state and local tax structures, the three legs being property tax, income tax, and the third leg is the sales tax. And in West Virginia at the state level, we have a 6% consumer sales tax rate. It applies to sales of goods and taxable services. There are a few local governments in West Virginia that can impose an additional tax of up to 1%. Compared to neighboring states, our neighboring states are Kentucky. There's no local sales tax in Kentucky. Kentucky has a 6% sales tax rate at state level. In Ohio, there is local sales tax at the county level, and the combined state and local rate in Ohio will range anywhere between 6.5% to 8%, depending upon which county you may live in. In Pennsylvania, the state sales tax rate is 6%, and there are two counties, only two jurisdictions in all of Pennsylvania that can levy a local sales tax. One is Allegheny County, which is where Pittsburgh is located, and the other one is Philadelphia County, where Philadelphia is located. In Philadelphia County, the local rate is 2%. In Allegheny County, it's 1%. But for the rest of the state, there's only a state sales tax rate of 6%. Maryland, there's no local sales tax, just the state sales tax is currently at 6%. In Virginia, there is a combined state and local sales tax across all jurisdictions in Virginia. And at the local level, you're typically either a city or a county, but not both. You do not usually have two levels of local government in Virginia, so the rates are fairly uniform in it, but there's some differences. The rate is either 5.3% or 6%. Now, the reason for that differential is a couple years ago, the state of Virginia enacted a significant transportation package. And there were citizens in certain areas of the state that wanted enhanced highways. And Virginia decided to give them enhanced highways, but they'd have to pay for it with local taxes. So in the localized level in certain jurisdictions, particularly in Hampton Roads and in the Metro DC area, the sales tax rate is 6%, with the difference going to for road construction. So that's our surrounding states. We have what is called the consumer sales service and use tax, and that word service has been in the sales tax structure since it was instituted in 1934. West Virginia enacted the sales tax in 1934 as one of many components designed to offset the lost revenue from the property tax limitation amendment. And unlike most other states who developed a sales tax based on goods, our sales tax from the beginning was based on both goods and services. Probably because our tax limitation amendment was far more severe than any types of limitations, similar limitations in other states. The use tax component was really not added until 1951, because when the sales tax was created in the 1930s, typically we bought all our goods and services from our neighborhood markets. Since then, we now are able to buy either at the neighborhood level, or in some cases through mail order or internet-related sales. And therein lies the development of the use tax, which complements the sales tax. Basically, if the vendor doesn't collect the tax and the tax is owed by myself, the consumer, then I'm obligated to pay the use tax. And indeed, we collect well in excess of $100 million a year in use tax as part of the sales and use tax component. Now, our sales tax generates, at least last fiscal year, more than $1.3 billion for state and local governments. And like I mentioned previously, the definition of the tax base is not uniform among states or local governments across the country. There are a lot of differences in base and in exemption values, so we're going to get into some of those differences today. The definition of tax base in West Virginia is the retail sale or lease price of tangible personal property and the furnishing of certain services. In tax year 2014, there were $18.5 billion of taxable sales in West Virginia. We had over 61,000 filers, but only 35,600 actually had tax liability. And the split, more than $1.1 billion was sales tax and more than $100 million was use tax. There are 46 states in the District of Columbia that currently impose a broad-based consumer sales tax. One of those states, the state of Alaska, it's not imposed at the state level, but local governments in Alaska impose a local sales tax at rates that are very comparable to what would normally be a state sales tax. And I guess if you live out in the tundra away from a municipality in Alaska, you're probably not worried about whether you have a sales tax or not. But in the areas of the state where we have population in Alaska, you will have a local sales tax. There are 4 states currently with no broad-based general sales tax. They are Delaware, Montana, New Hampshire, and Oregon. However, a couple of those states, Delaware and New Hampshire, have selective sales and or gross receipts tax. In New Hampshire, they tax meals, they tax hotel rentals, they tax leases under what would be a sales tax. In Delaware, there's a gross receipts tax. Generally, it's about 0.3 or 0.4% of gross receipts that's levied on a whole bunch of different sectors, both goods and service sectors. And that sort of almost serves like their version of a retail sales tax, but it actually is a gross receipts tax. In terms of there are different types of consumer sales tax. There's a vendor consumer sales tax. And then there's vendor tax, a consumer tax, and hybrid taxes. And in West Virginia, we're one of 17 states that have a tax that's imposed on the consumer selling price. And indeed, the name of the tax is consumer sales tax. And among those states include some of our neighbors, Maryland, New York, North Carolina, Ohio, Pennsylvania, West Virginia. Wyoming's not so local, but it's similar in many ways. We all have consumer sales taxes. There are 13 states that impose a privilege tax on the vendor's gross receipts. So it's not necessarily seen by the consumer, but the vendor pays a gross receipts tax, and it acts a lot like a retail sales tax. And those include California, Hawaii, Kentucky, New Mexico, South Carolina, and South Dakota. There's a couple states I have highlighted in red. The states I have highlighted in red, which include West Virginia, are the states that impose the most or the broadest level of sales tax on taxable services. Hawaii, New Mexico, and South Dakota being the top 3 states, and West Virginia right behind them. There are also 15 states in the District of Columbia that are considered to be hybrids. The legal incidence of the tax is on the vendor, but there's mandatory shifting provisions back to the consumer, and those include states like Alabama, Florida, Georgia, Illinois, Indiana, Kansas, New Jersey, Texas, and Virginia. There are advantages to having it in different ways and different forms, and when it comes to taxing services, probably the vendor tax in many cases works better than the consumer tax due to the nature of how certain services are performed. Tax is typically is applied to personal consumption, not all personal consumption, but personal consumption is what's subject to the sales tax. And in West Virginia, our consumption habits are a little bit different than the national average. The biggest difference is we spend a whole lot more on health care than the national average. And health care tends to receive preferential tax treatment, both federal and state. And for the most part, health care tends to be exempt from sales tax across the country, for the most part. Housing, certainly there's a lot of aspects of housing, particularly your mortgage and insurance, that are going to be exempt from sales tax, but goods that are used in the house like furniture and both durable goods and non-durable goods are subject to tax. Food is subject to tax in all the states that have a sales tax. Food away from home, definitely subject to tax, and in a number of states, food for home consumption also subject to tax. And then usually energy is not subject to consumer sales tax, except for maybe public utility services. A number of states tax public utility services under their general sales tax. In terms of sales tax collections, this is for calendar year 2005 by NAICS code. And the reason why I'm using 2005 and not some more recent year is because there was a casualty of the state's tax conversion system. The casualty is I no longer have good data on NAICS codes for industries. I'm trying to work around that, but because of that, I have to go back to 2005. And in 2005, about 57% of the tax was generated from businesses classified as retailers. The second biggest category was accommodation and food service. The third category was wholesale trade, followed by manufacturing. And then a good part of wholesale trade and some part of manufacturing have to deal with the construction industry. And there's also a portion that's attributable to various durable goods and prescription drug-related items that tend to be purchased by healthcare providers. Since 2005, we've expanded our exemption for drugs and durable medical equipment, so the tax level coming from the wholesale side and manufacturing side is probably a little less. These are folks that would collect the tax, of course, not pay it. And then a number of other categories like other services, information, construction, basically the real estate or leasing fields. We get a little bit from the professional technical side, amusement, recreation, waste management, and all other. But from pure retailers who define themselves as stores that sell goods, less than 60% of our tax is attributable to those NAICS codes. So we have a fairly broad tax that applies to a number of services. In terms of measuring West Virginia compared to states without a sales tax, a couple weeks ago I looked at income taxes, states that had income taxes or with earned income credit, and West Virginia actually had lower tax liability for lower income people without earned income credit than a number of states that had the earned income credit. Well, this week is a look at the tax burden for states that do not have a sales tax versus West Virginia. And for the most part, based on the way the Institute for Taxation and Economic Policy measures tax incidence, the states without a sales tax tend to have lower tax liability across the board on households than states with sales tax. Although for West Virginia, it's very close to a couple of the other states at 8.5% for the lowest 20%, and somewhere around 8.5% for the second lowest 20%. And then the top line is the all-state average for all states, the top blue line. Note that a number of these states that do not have sales taxes tend not to have too many people. They tend to be very small states. Oregon is about double the size of West Virginia in terms of population, but the other states all have significantly lower population than West Virginia. And certainly states like Montana and Alaska, which is not on this chart, have a significant amount of severance tax activity to go along with very low levels of population. How do states without sales tax fund government? Typically, a number of ways. One is through real property taxes, and this shows the ranking for those for a household with $130,000 of income. And states like Alaska, New Hampshire, and Oregon are in the top 20. And so Delaware and Montana also impose significantly higher property taxes on this resident than West Virginia does. In terms of income taxes, these states tend to have higher income taxes than average, in particularly Oregon and Delaware on a per capita basis. On terms of tax rate for the $130,000 family, the tax rate is a little higher in Oregon than it is in West Virginia, a little bit lower in Montana, but still in the top 20, and Delaware is 23rd. Alaska and New Hampshire do not have broad-based income taxes, but they use other taxes like property taxes to pay the bill. Plus they have significantly high corporate tax rates in those states. And the funding for elementary and secondary education, I just use as just a quasi-variable. States like Oregon and Montana tend to fund K-12 education at a lower level than West Virginia. How high is sales tax in your state? The highest sales tax rates tend to be in the southern states, in the southwestern part of the country. States that range from Tennessee on down to Oklahoma and Texas and Kansas and Missouri in between. California also has a very high sales tax rate. The area around West Virginia, with the exception of Ohio, generally has fairly low sales tax rates. And that sort of matters because there are leakages with sales tax, as with income taxes. Not everything is uniform. In fact, most states are not uniform when it comes to sales tax, and this is just an example. This is a sales tax rate. Both West Virginia and Maryland have a 6% sales tax rate. However, Maryland tends to round differently on their tables than West Virginia does. West Virginia follows the streamlined sales tax rules in terms of rounding. And for instance, from $1.42 to $1.58, you would pay 9 cents sales tax in West Virginia. For most of that same range, you would pay 10 cents in the state of Maryland. So not exactly uniform. That's one of the reasons why the streamlined sales tax project was put together, is to try to convince Congress that states could be uniform in a manner that would allow vendors from multiple states to collect taxes for multiple states. And the states in red are the full members of the streamlined sales tax project. Majority of them tend to be in the central part of the United States. There will be folks later on today who will talk more about the streamlined sales tax project, but that's try to streamline definitions in a manner that if I'm a vendor in West Virginia, I can reasonably understand what the rules are in Texas, Iowa, and places in between, so I can collect sales tax if I'm required to. Basic features of the sales tax structure. These are some that just about every sales tax structure has. There's a sale for resale exemption. If it were not a sale for resale exemption, I could rename the consumer sales tax the B&O tax, because it would be a business gross receipts tax at that point. There's credit for taxes paid elsewhere. If I show up and I have a legitimate tax paid to the state of Virginia, the state of West Virginia will give you credit for the Virginia tax paid. There's a use of, for many exemptions, and there's the use of exemption certificates to administer those exemptions. There's also the ability for certain folks to have direct pay permits to make their paying of the sales tax a little bit easier. Tends to be exemptions for a number of what I call low volume items, casual, generally non-business activities, the yard sale down the street, the flea market sale that occurs once in a while. Those tend to be exempt from tax, because it's also quite impractical to collect taxes in many of those situations. And then there's typically a number of exemptions for business inputs, which will vary among states. For methods of asserting an exemption, I'm going to turn it over to Mark Morton, who will give you the 4 different ways you can exert an exemption.
Well, yeah, you can see the slide there. Basically, oops, sorry. There you go. Is that better? You can see the 4 methods there. The exemption certificate. Nowadays we use the streamlined sales tax standard exemption certificate. You just fill it out, give it to your vendor, and the vendor keeps that on file, and then all the vendors' sales to that purchaser are treated as tax exempt. And when our people come in to audit, they look for that in the file, and that will typically vindicate that exemption. Refundable exemption: the purchaser just pays the tax to the vendor and then comes to the tax department, files a form to get a refund of the tax paid. A lot of the folks who have refundable exemptions actually use a direct pay permit instead, because that speeds it up a little bit and sometimes makes it a little easier to do the accounting. And what you do there is you just get a direct pay permit from the state of West Virginia. There's a standard application form, and the purchaser gives that direct pay permit number to the vendor, and often they'll just give them a copy of their direct pay permit itself. And then the vendor is authorized to make all of their sales to that purchaser without collecting the tax. But the purchaser will file a direct pay monthly tax return, because some of those purchases may have been taxable and some of them may not have been, depending on the particular purchase and the particular activity and identity of the purchaser. And so the monthly tax return is the means whereby the state receives its taxes to the extent that they are taxable. Per se exemptions are exemptions that are pretty much obvious from the actual sales tax documentation itself. If you've got an invoice that says you sold something to the United States government or to the United States Army or to another state or to a government agency or any of those entities listed there, or those items listed there, advertising, prescription drugs, etc., or obviously salary paid to your employees, those things are exempt per se. You don't need to look any further than the invoice itself to tell you that those particular transactions are not subject to the sales tax. And so there's quite a big list of per se exemptions nowadays. in our code or in our regulations, depending on where you look. I'll give it back to you.
In terms of exemptions, there's a couple different types of exemptions. There's exemptions based on the item that's purchased, but then there are also what we call tax exempt purchasers, people who are classified as being exempt based upon who they are. And the top of the list is federal, state, and local governments. We make sales to those entities. They're exempt from the sales tax. There are currently about 8 states out there that do not have an exemption for state and local governments. They actually tax them. Typically, those are going to be the vendor states, where the vendor is responsible for paying the tax. So if for some reason we wanted to tax the federal government, you'd have a vendor tax, and the vendor pays the sales tax, and regardless of where the sale is to. That's how that would be accomplished. Again, there's only a handful of states that do that. And by the way, if you want to tax the federal government, you better well tax the state and local governments. The feds get upset when you treat them unfairly. Educational institutions, same thing. There are about 8 states that do not automatically grant that exemption. Those are going to be vendor states, not consumer states. 501c3 or C4 nonprofits, under certain conditions, they're exempt from tax. There's about 15 states that do not necessarily automatically grant such exemption. Churches are in that list, as well as direct use industries. Direct use industries typically get partial exemptions, but they're outlined, and if you're a direct use industry, anything you directly use in your business activity is going to be exempt from sales tax. Sales taxation of manufacturing imports. Very few states tax manufacturing inputs, because this would cause a cascading and pyramiding effect. Currently, there are about 13 states that tax machinery that's purchased by manufacturers, although at least 8 of those states either tax it at reduced rates or offer some sort of partial exemption. There are some states that if it's a new or expanded industry, you're exempt. If you're not new or expanding, you have to pay sales tax. Again, very few of these, many of these states are not necessarily major manufacturing states either. States like North Dakota, South Dakota, and Hawaii are not what I would consider to be major manufacturing states. Raw materials, there's only one state that taxes raw materials, that's Hawaii. Hawaii is a vendor tax. Utilities and fuel, there are about 14 states that tax some utilities and some fuel that may be used in manufacturing. Of course, West Virginia and West Virginia's surrounding states, for the most part, are not in this group. Other than Kentucky, and Kentucky has been slowly moving towards a direct use exemption. In terms of direct use exemptions, these are industries that in West Virginia we effectively give a direct use exemption to. They include agriculture, and at least 30 states have a direct use exemption for agriculture. Manufacturing, 33 states direct use exemption on manufacturing. The transportation industry, 8 states. Transmission, 8 states have an exemption. Communications sector, 8 states. Production of natural resources. Not every state has natural resources, but most, not all, but most of the states that have natural resources tend to provide direct use exemption. Some of the states out west, like Wyoming, less so. Texas, less so. In West Virginia, gas storage, which was created as a separate activity, gets a direct use exemption. Production of or sale of electricity, operation of a public utility business, and I did not add it to the list, but there also, if you're doing research and development, direct use for R&D activity is exempt from, has a direct use exemption. This particular map comes from a study that was done on behalf of the Council on State Taxation. And let me see if I got a copy of this study in my, here it is. Basically, the study was entitled Sales Taxation of Business Inputs, Existing Tax Distortions and the Consequences of Extending the Sales Tax to Business Services. Was done in 2005 by Bob Klein, John Mikesell, who I just mentioned, Tom Newbig, and Andrew Phillips. And basically, this shows that West Virginia actually in a fairly favorable light, given our direct use exemptions. According to the study, under 33% of our sales tax originates from business inputs. You notice that every state that has sales tax taxes some sort of business inputs. mainly because it's very difficult to separate the business inputs from non-business inputs. Depends on how things are used. They can be used either for an individual or for a business, depending upon, and we don't always know that fact. But West Virginia under 33%, and other states in that same mold include Idaho and Michigan and Indiana and South Carolina. On the other end of the spectrum, states like New Mexico, Oklahoma, and South Dakota, as well as Washington, over 50% of their tax comes from business inputs. New Mexico and South Dakota tax more services than West Virginia does. State of Washington technically taxes more services than West Virginia as well, although a good part of their service taxation is under their business and occupation gross receipts tax. And this next slide illustrates if we were to extend the sales tax to business inputs, and I should back up a little bit. There's been talk for many, many years, ever since I started working with the tax department, about the need to tax more services. And I saw a recent Federation of Tax Administration publication that basically says, even though there's a lot of talk about taxation of services, there's been little action over the last decade or two on taxation or extending taxation to services. And when I come to think about it, part of the reason is a number of the services that states often target tend to be business input services. And you get a pushback on businesses, among others, concerning your loss of competitiveness if you were to extend tax to certain types of services. In this case, the Council on State Taxation Study identifies the number of services and the business share of those services. So if you advertising, the state of Florida back in 1987 decided to tax advertising. And for a period of a few days, they had blank screens on the TV set down in Florida. And shortly thereafter, Florida decided to reverse course. We have a number of other states that have enacted certain types of taxation on services only to reverse course before they took effect. Engineering and architecture, 96% of services are business employment services. Now, West Virginia actually taxes employment services, 94%. Management and technical, 88. Data processing, West Virginia exempts that, 84%. Accounting and legal services, 71%. Securities and investment services, 66%. Now, those that are principally household-related services include automobile repairs, and West Virginia taxes automobile repairs. Personal services, a number of personal services as defined in the NAICS code are actually taxed in West Virginia. Education services, which we tend to exempt because of the nature of who provides them. Amusements and recreation, we tend to tax most of those. And medical services, as most other states, we tend to exempt them from the sales tax. Now, we do have certain gross receipt taxes that we impose on certain healthcare providers, along with a number of other states, that amounts to sort of a quasi-sales tax. Here are the what I characterize the major West Virginia sales tax exemptions. At the top of the list is public utility services, and I put quotations around public utility because that was defined back in the 1930s, and some public utilities are less regulated today than they were in the 1930s. Professional services is a fairly significant category. Real property contracting services. Personal services, electronic data processing, advertising, daycare, and babysitting. I lump those two together. Personalized fitness program services. I'm getting pretty small on the service side now. Then when we move over to the good side, probably near the top of the list is prescription drugs and appliances, food for home consumption, motor vehicles, and motor fuel. But in the case of both motor vehicles and motor fuel, we have alternative sales taxation, and those taxes are dedicated to the state road fund. Digital goods, West Virginia currently does not have a definition of digital goods in its code. Other streamlined states usually do. Mobile homes, half the price is excluded. West Virginia clothing vouchers, because it's provided by the state of West Virginia, it's considered to be a state purchase and therefore exempt from tax. And then newspapers delivered by route carriers. If I go and buy a newspaper out of a newspaper box or buy it at the local grocery store, there's going to be sales tax on it. If I get it delivered in my mailbox at home, it's exempt. We're going to start on services. This is a Federation of Tax Administration survey of about 168 different services and how many services are taxed. And you'll notice that West Virginia ranks fourth highest among all states. And even though this was done in 2007, I'm confident that we're still right in that neighborhood. Probably the only significant movement might be the state of Ohio. Ohio has moved to expand some of its service taxation levels a little bit in the last decade or so. But other than Ohio, just about everybody is about where they are today, where they were a decade ago. Hawaii, New Mexico, and South Dakota all have what I call vendor taxes. That is, the tax liability is on the vendor, not on the consumer, even though it may certainly be passed on to the consumer. Now, at the top of the list of sales tax exemptions, this is a category that a number of other states actually impose sales tax. West Virginia, for the most part, does not, and that would be public utility services, such as electric power, natural gas, water, sewer, telecommunications, refuse, intrastate transportation, and I'm thinking of mainly persons as opposed to goods there. And these are really rough numbers. And I stress the word rough because until we would see the definition of what is being taxed and who is being taxed, very difficult to put an estimate on how much revenue could be obtained by eliminating an exemption. We do tax some of these services. We tax electric power under the B&O tax. We tax natural gas under B&O tax. We tax water utility under B&O tax. So in effect, we do already impose tax. It's a gross receipts tax, so it's sort of like a vendor sales tax on natural gas sales and water utility sales. Electric power, we do not impose a gross receipts tax, but rather we impose a generation tax on capacity, so that's a little bit of a different structure. But that B&O tax currently yields about $120 million a year. If we were to impose a broad-based sales tax on public utility services with an exemption for direct use activities, particularly manufacturing, you might get somewhere in the neighborhood of $200 million or so, give or take a little bit, which would be higher than your current yield on the state B&O tax. But it basically would make the tax more transparent to the consumer. Even though I pay a consumption tax called B&O tax on my monthly electric bill, on my monthly gas bill, on my monthly water bill, I do not see it on my bill because it's technically levied on the utility who passes it on to me, the consumer. By having it as a consumer sales tax, it's much more transparent on the consumer. You see it on your bill. Interesting enough, West Virginia is one of only a couple states. In fact, we may be the only state that does not have a broad-based consumption tax on telecommunications services, either a sales tax or gross receipts tax. However, folks have stepped into the void, so to speak, in that we have probably, if not the highest, one of the highest 911 fees in the country on both cellular phone service as well as landline service. So the local folks have sort of stepped into that void and taken it up. Plus, and if you're in a municipality, the municipal governments levy a 2% municipal excise tax on the local telephone bill. So there is tax there. Maybe not as high as other states, but there is tax. It's in the form of fees. Another area of major exemption is the professional services exemption. And this is something that tends to be somewhat controversial every year because just about every year, Mark Morton gets somebody that comes to his office over a tax, such as myself. And I say, Mark, why am I not getting a sales tax exemption? I'm a professional. I dress in a suit, got a tie on. And what do you say, Mark?
Well, I would typically refer that person to a state Supreme Court decision that occurred quite a few years ago, Woodell versus Daley. I don't remember us having this conversation. And basically it talks about what the criteria are to determine whether someone's a professional service provider under our statute. And they went with basically three criteria, one of which is just universal or near universal recognition of the activity as being professional. That certainly covers lawyers and doctors and so on. Continuing professional education was another criterion, and licensure by the state or some other organization, typically by the state, as a professional or as a special controlled occupation of some kind are the three criteria that the court said you have to look at. And I believe that particular case, Woodell versus Daley, dealt with an interior decorator who claimed to be a professional. And the court said, no, doesn't quite hit it. So that's why a lot of folks want to be professionals and claim that exemption, but the court hasn't quite opened the gate that far just yet.
Well, I'm an accountant. I do accounting work, and my sister lives in Ohio. She doesn't have to collect sales tax, and my brother lives in Pennsylvania. He doesn't have to collect sales tax. We're all accountants. Why do I have to collect sales tax?
Well, feel free to make an application to the.
I'm not a certified public accountant.
Well, there's the rub.
There's the rub. So anyway, the professional service exemption tends to be a bit more narrow in West Virginia than it is in other states, and therefore, once I don't get the right answer from Mark, I tend to go visit my representatives. I happen to live in Putnam County, and try to convince them that I'm a professional. And after all, the surrounding states don't tax this service. And in most cases, they're right, because West Virginia taxes more services than our surrounding states do. So this is one of those arguments that keeps coming up. And once in a while, there is a sales tax exemption that gets added to the code for some group who may consider themselves to be professional, but it doesn't fit Mark's definition of what professional is.
The court's definition.
The court's definition. I take it back. So anyway, the professional services, you'll notice I have a few categories here. Lawyers, accountants, those would be certified public accountants. Medical, which can be fairly large, and then a bunch of other categories. And for the most part, the only states that tax professionals, other than West Virginia's, who taxes some professionals who think they're professional, but we say they're not, are Hawaii, New Mexico, and South Dakota. All three have vendor type taxes. You notice under land survey in West Virginia is listed there along with Texas as tax and land surveyors. However, if the survey is done by a professional, like a professional engineer, then it's exempt. If it's not done by a professional, it is taxable. And so that's a little bit of a thing on the professional services side. When it comes to, if we wanted to tax medical is a very difficult area, because when I get my medical bill, it's what I have to pay as a copay after insurance. And sometimes insurance is Medicare or Medicaid, government-related insurance, sometimes it's private insurance. So the question is, what is the tax base? And if you're doing a regular consumer sales tax, probably your tax base has to be the copayment made by the individual, which is a much smaller component. So the states that tax medical, and actually the only one that really does under a consumer sales tax structure is Hawaii, but they're a vendor tax, and it's a gross receipts tax on the vendor. And Hawaii has a special advantage over the rest of us. You know what that special advantage is? There's not a whole lot of interstate competition. I'll go across the border and buy the service there. It's a little bit less of an issue in Hawaii than it is in West Virginia. So that's sort of the nature on the professional service exemption. Now, we also have an exemption for real property contracting services. And actually, West Virginia follows the majority of other states when it comes to taxation of contracting. That is, the usual rule is the contractors have to pay tax on all their purchases. But the contractor services tends to be exempt from tax. All states run into a number of issues. You have a contractor retailer, where the person is selling goods at retail side, then they become a registered retailer and have to collect sales tax on those retail goods. We have what I call manufacturing contractors, where the manufacturer makes something and ultimately sells it. A good example would be mobile homes. And one of the reasons why there's a 50% exclusion on mobile homes is we're sort of trying to tax only the materials and not the labor. And that's the manufacturing contracting. Then there's contract work for exempt purchasers. We have what is called a pass-through exemption that we provide to certain sectors of the economy, such as manufacturing, who can use their exemption, and the contractor gets the pass-through exemption because the contract is for a manufacturer, installation and plant and so forth. There are some exceptions to the West Virginia rule, and the rule from other states. The state of Arizona, for instance, does tax the final contract price, but they deduct 35% for labor. So it's their way of discounting the labor component. So it's similar to West Virginia, but a little bit different. In South Dakota, the contractors have to pay sales tax on all their material purchases, but in addition to that, there's a special excise tax on gross receipts equal to 2%, which is lower than their general sales tax rate, but it's a way that they're trying to get at the a little bit on the contractor receipts. In Mississippi, the general sales tax rate is 7%, but they also hit contractors with an additional 3.5% on all contracts above $10,000. In New Mexico, their gross sales tax, which is a vendor tax, it applies, but it allows an exemption for subcontractor costs. And one of the concerns that it has to be dealt with when it comes to contracting is oftentimes you have subcontractors, and you want to avoid pyramiding. So that's another reason why states tend to go with the taxation of materials rather than the taxation of the service itself. Another reason is that maybe not in all cases, but contractors tend to be smaller businesses, and it's harder to consistently collect and apply sales tax to smaller businesses than the larger businesses. And I'm going to turn this over to Mark. He's going to talk about the capital improvement rule that involves differentiating between a real property construction contract versus a taxable service.
Okay, what happens there is the statute does make that distinction between a capital improvement versus something which is essentially a service of some kind and not a capital improvement. We actually have a tax department publication, publication TSD 310, which is about 24 pages long, to give you examples and describe those criteria that we look at. But basically, it's a capital improvement if it adds value to real property. It becomes part of the real property as something that's permanently fixed to the real property or part of the property so that you can't remove it without damaging the property. And it's intended to become a permanent installation. If the end result of the service is a capital improvement, then the person who's doing that service is considered to be a contractor. They're engaged in contracting, and that service is not taxable. But at the same time, that contractor must pay the sales tax on his purchases of those building materials and process equipment that are installed into whatever the facility is that contractor's working on. If the end result's not a capital improvement based on those three rules, then the situation is different. It's simply a taxable service at that point, and the person who's doing that service can buy his supplies and materials subject to a sale for resale rule. You can see some examples that I just put together there. Repairs, touch-up painting, repainting, roof patching, mowing grass, placement of furniture, those kinds of things are services. They're not really contracting in the traditional sense, and they certainly don't fulfill those three rules.
Okay, that's construction. Now we move to some other major exemptions. Personal services are exempt from tax, and the one we often hear about most is barbershops, beauty salons, and nail salons, massage parlors, and tattoo parlors. These are services done on the individual. About $3.8 million in value. About 5 states currently tax those services. Probably the main reason why states never started taxing these services is oftentimes we got sole proprietorships that tend to be involved in providing some of those services. What I call death care services, which really isn't, it's basically embalming related to funeral and so forth. There are about 10 states that tax those. When you get beyond those services, you're getting into what I call healthcare related services that are not necessarily carried out by a professional service provider that involve care of individuals. And virtually, I'm not aware that any state other than those states that have that vendor gross receipts tax would tax those services. Other major services, electronic data processing. There's about 7 states that currently tax electronic data processing. I have a rough estimate of 5 million. It may be more than that. Electronic data processing, by the way, is the category where the Internet Tax Freedom Act fits under. That is, we do not tax internet access fees. That would be electronic data processes where that would fit. Advertising, there's only one state that we're aware of that taxes advertising, that's Hawaii. And again, it's a vendor gross receipts tax. It's almost like a B&O tax. We've taxed advertising when we had the broad-based state B&O tax years ago. Daycare services, babysitting services, typically the charge is fairly small, and it's a lot of effort, would be a lot of effort to collect that tax. And then daycare, again, very few states impose sales tax on daycare-related activities. I wasn't able to find any group there. Personalized fitness, that's the small one, couple $1 million at most. And back when I first joined the tax department many years ago, that was a taxable service. But what happened is a legislator was concerned about nonprofit organizations having to collect sales tax, and thought that was not the right thing to do. So there was an exemption moving through the legislature that would exempt certain nonprofits from sales tax collection, and some of these nonprofits actually provided personalized fitness services. And then some folks from the private sector came in and actually visited me, among others, and said, wait a minute, this isn't fair. I'm competing with that nonprofit charitable organization, and ultimately what came out of it was the personalized fitness exemption. One of our other major exemptions is food for home consumption. That's about $170 million in value. Does not include food stamps and WIC vouchers. Food stamps and WIC voucher purchases are exempt from state tax by federal law. That's at least $32.5 million, a fairly sizable exemption. Now, we do include candy in our food definition because candy is the definition of candy is very complicated. Is that the word to use?
Yes.
Complicated. So much so that a former tax employee many years ago, Dale Steger, spent hours and hours at streamlined sales tax meetings trying to figure out what candy was. He could tell you if he's still around here. I don't know if he's here today or not, but not here today. You know, if it has flour in it, it's not candy; it's a cookie. So that's what is not included in the food exemption is prepared food. Particularly food that's sold by eating and drinking establishments, basically all states that have sales tax, that type of food, and soft drinks. Soft drinks are subject to the 6% sales tax. Now, why we exempt food? There's some reasons for that. Makes the tax system less regressive unless the trade-off is a higher sales tax rate, because lower income people tend to spend more of their resources on food. But the interesting thing is states that exempt food tend to migrate towards higher sales tax rates. And if you're migrating towards a higher sales tax rate, it's less regressive to tax food than it is to have a higher sales tax rate. So that's one. In West Virginia, probably our main concern was geographical, concern about cross-border shopping. Virginia is the only contiguous neighbor that taxes food right now. It's taxed at 2.5%. It used to be taxed at 4% when Virginia reduced its sales tax on groceries for home consumption. At the same time, they raised their sales tax rate from 4% to 4.5%. This was several years ago. And then certainly residents may prefer other types of taxation, and in other states we tend to have much more in the way of income taxes and property taxes. And certainly in West Virginia, one of the reasons why we're able to get rid of the sales tax on groceries, and we're probably the only state that's gotten rid of it and reimposed it that I'm aware of, is because of severance tax. The coal industry and the food tax have a long history, and I'll point that out in a little bit here. Back in 1971, the majority of states with sales tax actually taxed food, about 30 states. Over time, that's decreased to 20 states in 1983. Still 20 in 1994, although 2 taxed at a lower rate. And now in 2015, there are 7 states that still tax groceries at a full rate, and 10 states that taxed at a reduced rate, for a total of 17. In West Virginia, this is the history of our sales tax on food consumption. We phased it out twice. And we phased it out in the late 1970s, went from 3% to 2% in 79, and then eventually to 0% as of July of 1981. At the same time it went to 0%, we raised our general sales tax rate from 3% to 5%. So that any gains from eliminating the regressive nature of food was offset by the higher sales tax rate. And then in 1988, the rate went from 5 to 6. We reimposed the sales tax on food in 1989, phased it out again between 2006 and 2013. It's currently at 0%. Typically, we eliminate the food tax whenever our ratio of per capita personal income to the national average is at or around 80%. And that occurred in the late 1970s. And occurred just recently, a couple years ago, where we had an all-time peak of a little over 80%. Typically, we remove food when coal severance tax revenues spike. In the late 1970s, we went from about $92 million in mid-70s to a peak of about $190 million, more than double. By the early 1980s, that's when we eliminated the sales tax on food. By the late 1980s, we dropped down to $124 million. We put the sales tax back on food. Beginning around 2005, the severance tax started to increase again. We gradually eliminated the sales tax on food. Currently, the severance tax is in a state of decline. The good news today compared to 20 plus years ago is that we have a rainy day fund. 20 some years ago, we did not have a rainy day fund to help back us when the severance tax goes in the wrong direction. These are sales tax. Gasoline and motor vehicles are exempt from the regular sales tax. However, they're subject to an alternative sales tax. In the case of motor vehicles, it's the motor vehicle sales tax. Rate's 5%. Yield last fiscal year was $206 million. If that were a 6% rate, it would be $247 million. Any vehicles that are subject to title registration pay the motor vehicle sales tax. Those include, by the way, recreational vehicles such as snowmobiles and all-terrain vehicles. I do note that there have historically been some compliance issues with the motor vehicle sales tax, particularly as it applies to some recreational vehicles. The tax department used to receive information from surrounding states on all-terrain vehicle sales made in those states where the sale was exempt from, say, the Kentucky sales tax or the Maryland sales tax because the sale was to a West Virginia resident. Then the West Virginia resident is supposed to take that vehicle into West Virginia, register it with DMV, pay the 5% tax. Well, in most cases, the West Virginia resident forgot about the detail of registering the vehicle with DMV. So at one time, many years ago, had a little program where we'd send out a little notice to these folks to say, you got a choice. Show us that you have your registration with DMV, go to DMV and register, or pay the 6% sales tax. And it's amazing how many people paid the 6% sales tax. They'd rather do that, or actually use tax, than register their all-terrain vehicle with DMV. So there's some little compliance issues because in order to pay that 5% tax, you have to register your vehicle with DMV. The 5%, there's also a 5% sales tax on gasoline and special fuels. It's levied on the average wholesale price of gasoline and special fuels, which is determined once a year on the basis of average prices between July and October. That would be average wholesale price. Current yield of that tax for the Department of Highways is about $200 million a year at the 14.1 cent level. It equals average wholesale price, and when prices rise, the yield goes up. When prices fall, the yield goes down. I expect that yield to get down again come January 1st. The current statute has a limit on the amount of change from one year to the next. The limit is 10%. So the maximum decrease is 1.4 cents a gallon on the downside or 1.4 cents a gallon on the upside. But that funds the highway program. Other major goods, they're exempt from sales tax. Well, digital goods, about half the states currently tax digital goods. West Virginia so far does not have a definition of digital goods in its statute. There is a streamlined definition that's out there. If we were to go that route, there would be a little extra money. Mobile homes, again, 50% off exclusion. A number of states have similar exclusions, and that's because half of the some portion of the mobile home is materials, and some portion is labor, is to discount the labor. West Virginia clothing vouchers provided every year about the 1st of August, a little over $1 million because of the clothing vouchers. Newspapers by route carriers, probably enacted many years ago because when I was growing up, we had paper boys or paper girls that delivered the paper, and usually every so often they had to go and collect the money from you. and that was a bit of an accounting problem for them to collect the sales tax as well. I think that's why we have the route carrier exemption that we have today. Distribution of the sales tax, of course, most of it goes to the state general revenue fund, more than 1.2 billion. Special revenue funds account for 45.6 million, and those include there's a transfer to Department of Highways each year, and that transfer is roughly $10 million. There's transfers to the School Building Authority, and then, which was recently given a slight haircut, and those amount, when they're at full level, over $32 million. And then there's we impose a 6% sales tax on prepaid phone services. And the PSC does the calculation, and based on their calculation, we transfer some money over to the PSC on a monthly basis, and that becomes part of their 911 fee distributions. We also have what I call a STIF diversion. Those are sales tax increment finance districts, where the sales tax is called by a different name and you issue bonds. And that was 14.9 million. And then the municipal sales tax was pretty small, only 16.4 million last year in collections for municipalities. Anytime there's a change made to the sales tax base, so if we want to increase an exemption or decrease an exemption or change, it will have an effect not only on the state sales tax, but also on the local sales tax, as well as the diverted sales tax. Local sales taxes across the country, local sales taxes only account for about 12% of total local taxes. And for West Virginia's contiguous neighbors, it's less than 5% of the total nationwide, which is about $69 billion. In terms of share of local taxes, our surrounding states, in Pennsylvania, only 3% of local taxes come from sales. In Virginia, it's only 7%. In Ohio, it's just 9%. New York, which collects the most local sales tax, is 16%, but New York is a very large state. States which rely very heavily on local sales tax for share of local taxes include Louisiana, Arkansas, and Alabama. And I point those three states out because those three states are close to West Virginia in terms of property tax liability for residents. That is, they all have low property taxes, and because they have low property taxes, the local governments seek the money from other sources. And in those states, you'll have very close to double-digit sales tax rates, with a good part of the sales tax rate actually being imposed by the local government, not the state. And in terms of local share of the general sales tax overall, again, Louisiana and Alabama show up very large there, along with Colorado and New York, where nearly half of the total state local sales tax is generated by the local governments, not the state government. Whereas in our surrounding states, Virginia, it's 24%, because Virginia has a lower overall sales tax rate, 18% in Ohio, and only 7% in Pennsylvania. A number of communities near the Ohio border are very much interested in the sales tax, because across the border in Ohio, the sales tax rate is generally between 7 and 7.25%, which is certainly higher than our 6% rate. And the taxation of cigarettes is a lot higher in Ohio as well, about $1.60 a pack versus $55 in West Virginia. So the number one commodity sold in West Virginia communities along the Ohio River tends to be cigarettes. Now, in West Virginia, our current municipal sales taxes, we have two groups of municipalities with sales taxes. We have those municipalities that do not levy a B&O tax, and under current law, they're allowed to impose a sales tax. And we have about 7 of those municipalities that currently impose local sales tax. They tend to be smaller in size than the average. And then we have municipalities with the B&O tax that began imposing local sales tax, starting with Huntington in 2012, and then Charleston and Wheeling in 2013, and then a few more cities here recently in 2015. Now, for West Virginia, I think folks may have realized this in the legislature. In West Virginia, the municipal sales tax really doesn't replace the B&O tax. The B&O tax is by far the largest source of local government revenue, and I have both Charleston and Huntington here. About half or more than half of their local tax revenues come from B&O tax. The sales tax in Charleston, that's at the full 1% rate. It would be about 18% of their collections, and in Huntington, about 22%. The big problem with the cities, of course, is under the property tax limitation amendment, they came out a little bit short on the stick, And the average municipality across the country, about half or more than half of their taxes are going to come from property taxes. In West Virginia, in these major cities, it's less than 20% coming from the property tax. So it would take, in the city of Charleston, it would take another 3% sales tax in addition to what they have. And if you add 3 plus 1 is 4 plus 6, that's 10% tax rate in order to get rid of their local B&O tax. So B&O tax is probably here to stay unless there's some way that we can reform the property tax structure. And with that, I'll open it up to questions.